What's up, guys? Welcome back to another video. This is going to be on zones and consolidation and chop. So let's get right into this. If you've been in this space for any amount of time, you've probably heard or seen on social media like people talking about chop or bad price action or ranges, range bound price action, whatever. All basically talking about the same stuff. So let's get into it. Now, what chop means is kind of like the name entails. Price action is doing a lot of this. Okay. It's not really going anywhere. It's basically stuck inside of a high and a low of that range. So that's why it's called the range, right? There's a high and a low that's very tight. Range bound means it's just bouncing off. It's playing ping pong. Fairly simple, I think, so far, right? So far, so good, I hope. Now, this in action looks something like this. So let me bust out my rectangle tool here, something like that. Okay, this is on the 1 minute chart, but same exact thing applies to any time frame. Just like how you can mark up support and resistance, key levels on any time frame, the same exact thing can be done with zones. So that's one of, for example, okay, this is another decent one. See, as you can see, right, it's not really going anywhere. There's not much follow through or continuation to the upside or to the downside. And every time it looks like it's about to break out and continue, such as here, it gets shoved back down inside the range and it stays in this little prison, price action prison, whatever you want to call it. Other people call it scalper's paradise. It depends on who you are, but it all means the same thing. Like, this is like a really nasty one. So in general, right, the tighter that these ranges are, like for example, this is the top is at 690, the bottom is at 670. This is a 20-point range on NQ. If you are brand new, then you don't really understand what that means, but that is an extremely small range for price to move in. Like years ago, or even months ago, really, in like March, April, the price action was like there were like 200 or 300 point swings per day, and like fairly consistently too. Like, ask anyone who was trading back then compared to how, and ask them how the action is compared to now. Okay, especially more recently, it happens when there's a lot more uncertainty in the markets. Right? Markets do not like uncertainty. They like when things are calm and things are predictable. However, recently in the past, like 6 months, I would say we've had, like 2-3 months, we've had a lot of uncertainty based on, Trump's tariff plan, interest rates, now war, obviously more recently. So a lot of uncertainty generally means that the market is not going to be moving clean. And, because trying to trade, like, okay, obviously there's always going to be periods of time that have these ranges. However, you want to catch these like expansion moves, these continuation moves, whatever you want to call them. Like I said, people have a million different names for all these things, but this is just what I call them personally. But you want to catch these continuation moves outside of these ranges. You do not want to, okay, at least I do not really like to be inside of these zones. In my opinion, it makes it much harder, and the risk to reward is typically not very favorable. I'm just speaking for the masses, but more importantly, speaking for myself. But yeah, anytime you hear someone talking about a range or chop, this is what they're talking about. And especially if you are newer, I would suggest trying to stay away from it. But first, you need to understand how to identify when it's bad price action or when it's a choppier market. So this part is very simple, just like the drawing up support and resistance. It's very easy. I don't know if people don't want to like admit it because it like doesn't sound as cool, but a lot of trading has to do with pattern recognition. We are a creature of habit, which means that there are a lot of patterns that are relatively easy to predict and identify. I'm not going to say easy to predict, but identify most definitely. And this is an example of them. So whenever you see, I'm doing my best to explain this because I've been doing this for so long. It's just natural to me. Like, if I see something like this, it's very easy for me to identify like top and bottom of this range. This is chop. But to the untrained, like if you are new, then obviously it's going to take repetitions. It's going to take time. But really, if you see price not really moving anywhere, it's moving sideways like it is right here. Just bust out your rectangle tool and then start marking them up. And what is worse than just a zone is when you have a lot of fake outs in either direction, such as this. Oh yeah. This is called a false breakout. So that's basically where a lot of people get trapped. They get caught off sides. A lot of buyers were stepping in here, trying to push things higher. However, it was not enough, and ultimately, obviously, came back down. Now, if to the reverse direction, if price broke out of this range to the downside, there'd be a lot of people shorting, thinking that there's going to be continuation, because they're like, okay, in your head, if you see this nastiness, this nasty price action, and you see that price is finally starting to break out and move higher or move lower, doesn't matter, just break out of that range, period. There's always going to be a part of you that's like, this is it, like this is finally the move that I've been waiting for. Let me go long here or let me short here so I can catch this move. And then you take your position, then price reverses on you, and now you're back in that zone. You're going to lose money, you're going to get screwed. If you've thought like that, or if you think like that, you're definitely not the only person. That's exactly why these moves happen. This is kind of for a different video, but the best moves in the market are always coming from where the most amount of people get caught on the wrong side. Just like in this example, just because it's right in front of me, a lot of people thought that this was finally the move. This was the way out. They saw the light at the end of the tunnel. They're like, we're moving back to whatever next level to the upside. Let me go long here. Then a lot of those people lost money. They got caught off sides, and then things got shoved back down in that range. A good example, honestly, a picture perfect example is on BTC. This is a prime example of a very notable zone on a higher time frame. So I want to see this. Okay, there we go. Okay, BTC is almost the picture perfect example of a zone and then a fake out. Also, quick side note, zones don't have to be exactly perfectly horizontal. They don't have to always be like this. You know, you can have a zone, technically it's called a channel, but it's the same exact thing. It's just a zone that is slightly tilted. That's the only difference. So right here, this is on BTC on the weekly chart, the months leading up to November of last year, where we had this massive breakout out of this channel, out of this downward channel on BTC. So as you can see, right, very tight. Technically, it's moving lower. There's lower lows and lower highs, so it's in a downtrend. However, this is another perfect example of a fake breakdown. So you had this very clear and distinct channel. This is on the weekly time frame, so you can, if you want to break it down to the daily or the hourly, whatever, it'll be even more clear. There will be more candles, but for the sake of this example, we're on the weekly. So you have this clear and notable channel on the weekly time frame, right? This is a higher time frame, so there's a lot of weight that this carries. The higher the time frame, the more weight it carries. So on this, just right here, what do you notice? You see that we are in this clear downward channel. Then you see this wick right here. I wish we could see how much money, like how many people and how much money got trapped trying to short this, right? Because especially like leading up to the election, right? There's a lot of uncertainty. There were a lot of wild swings that were going on in the markets. If you were there and participating, you would remember. Everyone thinks that the future of the country, the future of the nation, the future of like the financial markets is in the hands of this election this year. So there's a lot of uncertainty going on. Now combine that with a notable and a technical breakdown, which was about to happen, because keep in mind, this candle, at one point, this candle was red and it looked like this. Imagine you don't see anything else, right? You don't know what happens in the future, obviously, when you're in a position. However, you see this candle, a lot of people were like, wow, this is definitely going to go back to, 20,000 or zero, whatever. So they all short here out of this zone. We finally got that break out of that zone. I'm going to short here and make a bunch of money. However, obviously that is not what happens. And the candle closes now back inside of that zone. All those people who went short there are already trapped. They're already losing a bunch of money. And then eventually had this massive expansion move outside of the zone to the upside. So that's why you need to watch out. And like I said in the previous video, you need to always wait for the candles to close. If you want the highest probability of being correct and not getting rinsed, always wait for the candle to close as confirmation. Don't be like these people who shorted here at the bottom and then they got instantly ripped to shreds. You finally got a proper breakout and a proper candle close here on this green candle, and then you got that retest wick back into that zone, and then it flew, right? So this is the proper way to identify and use zones in actual practical application, practical scenarios. So keep that in mind, get some practice in. All you need is click on this little trend line tools arrow in the top left. That's called parallel channel. For horizontal zones, I just use the rectangle tool. So click on the brushes, click on the arrow. Then down here it says rectangle. So use that. There's your horizontal zone. But if you have, channels or like slightly non-horizontal zones, whatever you want to call it. Just use the channel tool and you're good. So get some practice in. The same exact thing for the support and resistance video, right? You can do this on any single asset. Does not matter what it is. Doesn't matter if it's NQ or NVIDIA or BTC or Apple, like I said in that previous video. Does not matter. So keep that in mind and get some practice in. Open up a chart, whichever one it is, it doesn't matter. Get some practice in. You need to be able to understand and identify these things if you want to be able to leverage them in your strategy. Every single trader needs to understand support and resistance, supplier demand, key levels, pivots, whatever you want to call it, as well as zones. Okay. They help you identify areas in price where you want to avoid, because most people have the hardest time when things are super choppy and very range bound, right? That's where the most people get cooked. And if you don't want to be like most people, you need to understand how to identify those conditions and avoid them entirely. That's what I try to do. I don't like to sit through, action like this. I like to catch things that look more like this, okay? We're not going sideways. Things are moving and grooving. Whether to the upside or downside doesn't matter. But the last thing that I want to do is sit through this pinball action, okay? So I would suggest you get some reps in, open up a chart, any time frame, it does not matter. 1 minute, 5 minute, 15 minute, 1 hour. You'll find this play out in every single time frame. So get your practice in, and I hope that helps. Appreciate you watching, and I'll see you on the next one.